Hi friends, very good afternoon. Uh, I decided to do a video today because it was a holiday for everyone in India, and I thought let me make use of this opportunity. So today I'll be talking about a very important concept, which is uh, we all are aware, but we seem to forget from time to time. Now it's called asset allocation. But before that, please note that this is a free educational video purely for the purpose of learning. This should in no manner be considered as any kind of advice, offer, or promotion to sell anything. This is purely for investor education. Okay, now what exactly we mean by asset allocation? So, for example, um, let's say you invest all your money in a particular asset class, let's say equities, and for some reason it doesn't do well in a particular year. So obviously you end up uh, having a notional loss until you book it, and you may feel disheartened. And the same may repeat next year, and it may go up in the third year and again come back in the fourth year. So, as an investor, the experience gets very diluted, or it's not a very good experience. So, you need to look at a couple of asset classes where you can put your money so that the overall experience is much better and the volatility in returns gets reduced. That is exactly in layman term what we mean by asset allocation. So that means allocating your money in the proportion that you wish to as an investor, depending upon your risk appetite, into different asset buckets. For example, the asset buckets may be partially, uh, for example, equity, as I've already explained. Now, in equity, some people could invest into mutual funds. The aggressive ones, uh, may invest into equities in the form of mutual funds, may invest into direct stocks, depending upon their take and their risk abilities. And some investors may also look at investing into debt. Now, debt is a much vaster, uh, beg your pardon, much vast field of reach. So you can get into mutual funds and debt. You can buy common bonds. You can get into various subcategory of bonds, as I've shared in my earlier videos. It could be government bonds, it could be private company bonds, it could be perpetual bonds, it could be tax-free bonds. Apart from that, you could also enter into alternate assets. Like some people may end up into buying real estate. Some people may end up buying physical gold. Some people may buying end up buying PMSs, alternate investment funds, depending upon one's risk profile. So what happens is if you look from that particular angle, your overall risk gets neutralized, or not, I would say neutralized, gets reduced to a much greater extent. Of course, historical returns does not guarantee any form of guarantee for future, but then what history tells us that if you have diversified decently, the chances of making returns are much better. So keep asset allocation in mind. Cut the noise in the market which you hear about asset class going up, going down. Look at long-term return of all these asset classes, be it equity, be it debt, be it gold, be it real estate or any alternate asset, and invest with a long horizon. Now, of course, long horizon does not mean it will be a very long period. It could be depending upon the goals that you have. For example, some goals require different asset allocation, which are short term goals, some require medium, and some require long term asset allocation. That you will only decide as an investor, and that will shape up your overall investor experience. And with regards to taxation, please consult your tax experts for tax related advice on the same to get an overall best risk adjusted return. Thank you very much, and I hope you like this video. Take care.